Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a company so massive, it's not just making blockbusters like Barbie or hit series like Succession, it's also dealing with, well, a huge $38 billion in debt, all while trying to pull off one of the boldest corporate splits we've seen in ages. We're talking about a real titan in entertainment and news, basically on the verge of completely reshaping itself. So today, we want to cut through all that noise, give you a really clear picture of the leadership, the business model, the competition they face, and this huge gamble they're taking. The big question we're asking is, will breaking itself in two actually unlock some kind of explosive growth for this media giant? And maybe more importantly, what does the transformation mean for you, the individual investor, watching all this happen? Let's dive right into the architects of this change, the leadership team steering Warner Bros. Discovery through this, well, monumental phase. Right at the top, you've got David Zaslav, the president and CEO. He's a really fascinating figure in media today. Built Discovery into a global powerhouse over 15 years, then TLC, HGTV, Food Network, and before that at NBC Universal, he was key in launching CNBC and MSNBC. Zaslav definitely has this reputation for finding undervalued assets and, frankly, turning them into moneymakers. But his time leading the merged Warner Bros. Discovery, that's been, well, a lightning rod. Lots of praise, but also some really sharp criticism. See, right after the merger, Zaslav went straight into this aggressive $3 billion cost-cutting campaign. You probably remember some of the, let's say, more controversial moves, like shelving completed films, Batgirl being the big one, purely for tax write-offs. That wasn't just a small thing. It sent real shockwaves through Hollywood. His strategic shifts didn't stop there. He restructured HBO Max to focus on profitability, even deciding to change the name back to HBO Max by mid-2025. Analysts actually think that rebranding alone could boost subscriber retention by about 10% in key areas, which is pretty significant. His leadership style, decisive, very data-driven, and honestly unapologetic. He's been laser-focused on tackling that massive debt, but that approach has definitely caused friction with creatives. They feel he's prioritizing Wall Street over storytelling. It's a really tricky balance he's trying to strike. And his ability to keep that balance, absolutely crucial for the streaming and studios part after the split. Okay, then there's Gunnar Wiedenfels. He's the CFO, and he's set to become CEO of the global networks side after the split. Wiedenfels is a German-born financial strategist. He really sharpened his skills at places like McKinsey and Siemens, leading some complex corporate turnarounds. His financial discipline has been absolutely key in WBD's big push to reduce debt. We're talking a $2.2 billion repayment in just the first quarter of 2025. And he's the one who engineered this bondholder-approved plan to repurchase almost half of their huge $37 billion debt. His real masterstroke, though, from a financial angle, is orchestrating this tax-free split. Now, this is a huge deal for you as an investor, not just some finance jargon. It basically means when WBD splits, they legally sidestep a massive corporate tax hit on the deal itself. That saves billions that would otherwise go to taxes, allows them to plow that capital back into growth, paying down more debt or shareholder returns. It's a really smart financial move. Wiedenfels' plan for global networks is to use CNN's news credibility and TNT Sports live events to keep the cash flow strong. He's already shown he can grow subscribers with Discovery, plus Dela, which saw a nice 15% year-over-year bump in Europe. He's kind of a quiet, super sharp force getting ready to manage the cash engine.
Yeah, and what's really striking when you look at this leadership setup is that deliberate duality. It's clearly reflected in who's running things. You've got Zaslav on one side, the big deal maker, the cost cutter, charting the ambitious path for the premium content side, chasing subscribers and blockbusters. Then on the other side, Wiedenfels, the financial architect, is methodically prepping to manage the cash flow engine, those more stable, maybe declining, but still vital, traditional media assets. It's almost like two different philosophies embodied by the top leaders. Zaslav's betting on the future, Wiedenfels is managing the present. The real challenge and maybe the key insight for investors is whether these two very different approaches can actually work together under one roof, or if splitting up is the only way to avoid, well, internal clashes. And it's not just those two. You also have Samuel DiPiazza Jr., the chairman of the board. As a former global CEO of PwC, he brings that deep governance and financial oversight perspective. Very important. He was really instrumental in guiding the company right after the merger through those initial bumpy months.
And crucially, he led the board in approving this split, really pushing for pay-for-performance alignment in how the execs get paid. His role is to make sure WBD's big moves are carefully checked for long-term value. Although you do hear some investors worry his maybe more risk-averse style could potentially hold back some creative innovation. It's always that balance, isn't it? Stability versus bold moves. And then, of course, there's Casey Bloys, chairman and CEO of HBO and Max Content. His role, absolutely critical. He runs the engine for WBD's premium content. Bloys is a real veteran. Came up through the ranks at HBO, greenlit massive hits like Succession, The White Lotus, you know the ones. His strategy is pretty smart, too. He uses a data-driven approach, leverages viewer analytics to focus on series that really engage people. Apparently, this boosted Max's average watch time by something like 20% since 2022. That's significant. And he seems to have a good eye for scalable IP, like turning The Pit into a potential multi-season franchise. That alone could bring in maybe $500 million extra by 2027. His leadership is just essential for the streaming studios unit hitting its growth targets.
Making sure they're not just making shows, but smart shows.
So, okay, pulling this all together, what does it mean for you, the individual investor? This isn't a company led by its founder, right? Which puts a huge amount of pressure on this professional management team to deliver results. You don't have that kind of long-term founder vision. It's all about execution, hitting the numbers. But the big question remains, are these leaders really business geniuses who can actually pull off this incredibly bold plan? Zaslav's aggressive cost-cutting sounds necessary with all that debt, sure, but it clearly ruffled feathers among creatives. Does he risk the long-term quality of the content by focusing so much on short-term financials? Or was that, the only way to keep the ship afloat?
It's a really valid point. Zaslav's time at the helm has definitely been polarizing. Yes, the aggressive cost-cutting did stabilize the finances during a really chaotic period post-merger, but it also led to very public missteps. Batgirl's the obvious one. That wasn't just unpopular. It sent a really stark message, cost discipline over creative output. And it caused a major firestorm in Hollywood. And if you needed proof of how some shareholders feel, remember that significant 59% vote against his massive $51.9 million pay package for 2024. When you compare him to someone like Bob Iger at Disney, who's generally praised for fostering creative synergy, Zaslav's legacy really hangs on whether this split succeeds. Can he actually make streaming in studios a real competitor to Netflix? If he does that, maybe the genius label starts to fit. But right now, it's very much an open question, a real tension between the balance sheet and the blockbusters.
And looking at how these leaders are incentivized, there's a definite shift happening. It really signals the board's commitment to making this split happen. Post-split, Zaslav's target annual pay actually goes down to $24.5 million. But here's the important part. It shifts heavily towards long-term equity, specifically 60% in performance vesting stock options. So his financial success gets tied directly to how well that streaming and studios unit performs. There's even this one-time sweetener, 20.9 million stock options that he loses if the split doesn't happen by 2026. Talk about motivation. Gunnar Wiedenfels' pay in 2024 was $12.8 million, and his package after the split is expected to look similar to Zaslav's very equity-heavy. Now, while these WBBD packages are high, they aren't totally out of line compared to others in the industry. Bob Iger at Disney got $31.6 million in 2024. Netflix's Ted Sarandos, $49.8 million. However, here's a key point for you to think about. Internal ownership. Zaslav only holds about 0.3% of WBD shares. Wiedenfels even less, 0.1%. That suggests maybe limited skin in the game compared to, say, Reed Hastings at Netflix, who owns 1.2%. It does raise questions about how personally invested they are in the long-term success beyond just hitting the targets in their incentive plans.
Right. And zooming out, this whole compensation structure, plus the board's actions, it paints a very clear picture. Execute the split. That's the mandate. The deliver or forfeit aspect of these incentives, well, from an investor's viewpoint, it's kind of a double-edged sword. On one hand, yes, it drives incredibly aggressive action, a real focus on hitting those targets, get it done. But on the other hand, it might risk prioritizing short-term wins over the kind of long-term patient innovation that builds really lasting value. It's a trade-off they seem very willing to make right now.
Mm-hmm.
Let's touch on WBD's mission, vision, and culture, too. Their official mission is to be the world's leading storyteller. Simple enough. Post-split, the vision is very clear. Two focused companies. Streaming and studios aims to dominate premium content. Global Networks focuses on maximizing cash flow from news and sports. The culture, though, that's still, let's say, evolving. The challenges integrating after the merger were pretty significant. You had Warner Media's creative-first culture clashing pretty hard with Discovery's lean, profit-focused approach.
It was almost like trying to merge a Michelin-star kitchen with a highly efficient fast food chain. Both have their strengths, but mixing them caused some serious internal friction. Zaslav's cost-cutting, including over 1,000 layoffs in 2023, definitely strained morale, particularly on the creative side at HBO. Casey Bloys has reportedly been working hard to rebuild that trust, promoting a creator-first vibe at HBO, signing deals with key showrunners. Global networks, under Wiedenfels, will likely double down on operational efficiency. You've even heard about CNN looking at AI tools for newsrooms to cut costs. WBD has this huge goal: make HBO Max a top 3 global streamer by 2030, targeting 200 million subscribers, up from 122.3 million now. That's a massive jump, and it absolutely needs a more unified culture to get there, something that still seems a bit fragmented today. Looking ahead, the leadership faces some key risks. First, succession planning. Zaslav is 65, Wiedenfels is 48. Neither has a clear, publicly named successor. The complexity of this split could easily push that planning down the road, which creates instability risk if either leaves unexpectedly. Second, there's a real over-reliance on Zaslav himself. His deal-making style means the company is quite vulnerable to his decisions or potential departure. Third, the shareholder distrust we saw with the pay vote 59% against could limit Zaslav's strategic flexibility, might force him to be more cautious. And finally, cultural integration even after the split. Aligning streaming and studios' creative focus with global networks' cost discipline could actually make existing tensions worse, hindering collaboration. And when you compare this leadership team to their peers, well, Zaslav is an expert operational fixer, no doubt, but he doesn't really have the creative halo that someone like Disney's Bob Iger does. Iger's return to Disney really boosted confidence, and Disney Plus has 164 million subscribers, more than HBO Max's 122.3 million. Though, to be fair, HBO Max is more profitable right now. Reported $339 million EBITDA in Q1 2025 versus a loss for Disney Plus faller. Netflix's Ted Sarandos is very much a content-first leader, which contrasts with Zaslav's financial focus. And Netflix's 277 million subscribers just dwarfed WDD's current scale. The Wiedenfels. His financial smarts are definitely top tier, comparable to Disney's CFO, Christine McCarthy. But being CEO is a new role for him, so there's some uncertainty there. Overall, WBD's leadership is strong on execution, especially finance. But they absolutely have to prove they can match their rivals on creative output and subscriber growth, especially for the streaming side, to really make this gamble pay off.
Okay, so we've looked at the leaders driving this change. Now let's peel back the layers and see what exactly they're changing. How does this media giant actually make money day to day? It really is like a dual engine setup. And for you, the individual investor, it's actually pretty understandable once you see that split. Think of it like a chef running 2 kitchens. One kitchen makes gourmet dishes, HBO Max shows, big Warner Bros. Movies for subscribers. The other kitchen serves up reliable staples, CNN News, TNT Sports, Discovery reality shows, mainly for traditional cable folks and advertisers. The tricky part, though, is managing that huge $38 billion debt while trying to grow the streaming side and manage the decline of the cable side. It's a really high-stakes balancing act. So let's break down the offerings from these 2 kitchens. First, streaming and studios. You've got HBO Max. Premium streaming, 122.3 million global subscribers as of Q1 2025. It's seen really impressive 23% year-over-year subscriber growth. Offers those prestige originals like Succession, The White Lotus, plus movies, DC stuff. The sheer quality and breadth here isn't just about individual hits. The key insight is how deeply WBD is woven into pop culture. It creates this powerful pull that's hard for competitors to replicate. It's cultural currency, really. Although it is worth pointing out that their average revenue per user, the ARPU, actually fell 9% to $7.50. That's mainly because they introduced cheaper ad-supported tiers. Now, that's not just a small detail. It tells you that as they add more subscribers, many are coming in on those lower price plans. Strategic choice, go for volume over higher individual revenue. But it does impact the profitability per subscriber. Then you have Warner Bros. Pictures. That's the movie studio Dune. Part 2, the Barbie phenomenon. They brought in $3.8 billion at the box office in 2024. Sure, some recent ones like Furiosa didn't perform as well, but Superman in 2026 is already projected to hit $1 billion. Shows the power of that IP. Warner Bros. Television is like a factory, pumping out shows. 40 in production, including that anticipated series The Pit. DC Studios oversees all the superhero IP. They've got a rebooted slate under James Gunn, targeting something like $2 billion in revenue by 2028. And don't forget Warner Bros. Games. Huge hits like Hogwarts Legacy, 22 million copies sold in 2023, adding $1 billion to the top line. This whole segment is really about high-value, high-impact content with global appeal. Okay, now over to the global networks kitchen. Here you have CNN, still a global news leader, reaching something like 370 million households. They're pivoting to digital, planning a CNN streaming service, hoping to offset the 10% decline in traditional cable ad money. TNT Sports airs Major League games, NBA, NHL, MLB, brings in about $1.5 billion a year in rights fees, although potentially losing those NBA rights in 2025, that could cost them $500 million in revenue. A big hit to cash flow if it happens. Discovery, with its reality reality and lifestyle channels like HGTV and Food Network reaches 300 million viewers globally. Its streaming service, Discovery Plus of Air, has 25 million subscribers, up 15% in 2024, so decent digital growth there. And finally, Bleacher Report, the sports digital platform, 50 million monthly users, pulls in about $200 million in ad revenue. This side of the business is really about generating consistent cash flow and maintaining broad, even if declining, traditional reach.
Yeah, what's immediately clear is how they're trying to play both sides, leveraging that premium, curated content and the mass market appeal. This kind of dual approach is actually pretty unique in the media world right now. You don't see many others trying to compete head-on with Netflix and Disney on streaming, while also trying to maintain dominance in traditional cable news and reality TV. It's definitely a high-wire act, but if they manage it, it could provide unparalleled stability.
Exactly. The uniqueness of WBD is really in this hybrid model. It combines HBO's prestige and Warner Bros. Incredibly valuable IP that lets them compete with the pure streaming giants. But at the same time, it keeps CNN's news dominance and Discovery's low-cost reality shows, which churn out stable cash flow. This duality, high-margin streaming plus these cash cow networks really sets WBD apart from pure streamers like Netflix or even legacy players like Paramount. At its heart, the company's passion is storytelling. Whether it's a critically acclaimed HBO series or a relatable Discovery reality show, its economic engine is monetizing all that content.
Often through really lucrative licensing deals, like getting $500 million from Netflix just for Friends. Now, while they excel at premium scripted stuff, integrating all these different assets has clearly been a struggle. It's not as seamless as, say, Disney's ecosystem. A good example is HBO Max's Euphoria. Huge hit, drove 30% subscriber growth in 2022. Shows their content power. But then you look at CNN's ongoing lag in digital. It shows there are still execution gaps in some areas. WBD's history is really one of reinvention. Warner Bros., founded way back in 1923, pioneered sound in movies, built a studio empire. Discovery launched in '85, basically redefined cable TV with affordable, engaging content. The 2022 merger that created WBD, combining Warner Media and Discovery, was this ambitious attempt to marry premium IP with operational efficiency. But it definitely stumbled hard under all that debt and the difficulties of integration. Key moments on this path: AT&T buying Time Warner for $85 billion in 2018, creating Warner Media. Then the 2022 merger forming WBD, starting with $38 billion in debt despite $12 billion in revenue. Ouch. In 2023, HBO Max hit 100 million subs, which was a bright spot.
And then most recently in the 2025 split announcement, which actually saw the stock jump 14% in a month. The company's shift towards streaming, cutting cable reliance from 60% to 40% of revenue since 2022, shows real adaptability. But like we said, missteps like potentially losing the NBA rights, that highlights the ongoing execution risks in this big gamble.
Okay, so how does this giant actually function day to day? It's a pretty global operation. HQ is in New York City, though they lease that space. They own the famous Warner Bros. Studios in Burbank, California, 110 acres for film and TV. Plus, Warner Bros. Studios Leavesden in the UK, where Harry Potter was filmed. They also own CNN Center in Atlanta for news, while Discovery's old HQ in Silver Spring, Maryland, is leased for reality TV. All told, offices in 50 countries. Major hubs in places like Mexico City for streaming, Warsaw for Discovery, plus TESS. Owning those key studios is crucial for controlling content creation, but they strategically lease most offices, which keeps capital costs down. They even outsource things like IT and HR, saving maybe $200 million a year while keeping content creation fiercely in-house to control quality. Which brings us to vertical integration. Warner Bros. Discovery is highly vertically integrated. They control content creation in their studios, distribution through HBO Max and CNN, and monetization via licensing. This really cuts down their reliance on third parties. Take Harry Potter, for instance. Owning that IP lets them make films, games, theme park experiences, generating something like $1.5 billion annually across all of it. It's like having their own private gold mine that just keeps producing. Although it's worth noting their supply chain for physical stuff, like DVDs or merchandise, still leans heavily on manufacturers in Asia. That does create some geopolitical risk. Their distribution model, it's definitely multi-channel. They cast a really wide net. Direct-to-consumer HBO Max, Discovery Plus that drives 60% of their streaming revenue. Ad-supported tiers help boost engagement there. Their global networks reach 3 billion households via cable and satellite deals with giants like Comcast and DirecTV. Though cord-cutting keeps chipping away at that base. Theatrical releases via Warner Bros. Leverage global cinemas, bringing in that $3.8 billion box office in 2024. And they have those lucrative licensing deals with platforms like Netflix and Hulu, generating another $1 billion annually. Innovations like the HBO Max ad tier and bundled deals, like that 2024 Comcast agreement that boosted HBO Max penetration 15% in the US, show they're smart about getting content out there. They really know how to get their stuff in front of your eyes one way or another. Now, when you look at revenue predictability, WBD's is moderately predictable. Their streaming and studio side, that's 40% of their $38.34 billion 2024 revenue. It's mostly stable, about 80% recurring subscriptions from HBO Max and Discovery Plus A, but global networks, the other 60%, that depends more on volatile ad revenue and those cable carriage fees. While maybe half of those fees are locked in multi-year contracts, cord cutting and swings in the ad market make it less steady. For example, their Q1 2025 revenue actually fell 10% to $8.98 billion. It missed estimates, which really highlights that unpredictability. Okay, let's talk threats and resilience. Every big company faces them, right? What's keeping WBD leadership up at night as they plan this gamble? Some threats are huge, others are more like nagging problems. The really big one, the potential game changer. It might be AI-driven content. Competitors like YouTube using user-generated stuff have much lower costs. If AI gets good enough to create compelling content cheaply, it could really disrupt WBD's expensive production model. Then there's regulation. Antitrust scrutiny could limit future M&A, which might be important for growth after the split. Geopolitics, particularly U.S.-China tensions, could mess with supply chains for merchandise or co-productions. Maybe a $500 million revenue risk there. And of course, the competition is just brutal. Netflix has 277 million subs. Amazon has a $20 billion content budget. That kind of scale puts constant pressure on WBD's market share. But despite all that, WBD isn't without its strengths. Its core resilience really boils down to two main things. First, that content pipeline and the enduring power of brands like HBO. That's allowed them to pivot successfully to streaming. HBO Max's $1.3 billion EBITDA target for 2025 seems on track. Second, their aggressive debt reduction plan is designed to make both companies leaner, more agile after the split. However, that $38 billion debt load and still relying heavily on cable definitely limit how quickly they can adapt. They've shown flexibility before, like licensing Friends to Netflix when cable was declining fast, but WBD simply has to innovate faster to really thrive in today's chaotic media world. It really feels like a race against time. Okay, this is where it gets really interesting. What actually gives this company its edge? Does it have a real moat around its business, protecting it from competitors? Well, talking about monopolistic traits, WBD doesn't dominate completely, but it holds very strong positions in key areas. HBO Max is third globally in premium streaming, about 12% market share. Netflix has 20%, Disney Plus 15%. CNN reaches 370 million households, a global news leader, even if Fox News beats it in the U.S. ratings. The barriers to entry are definitely high. Copying WBD's huge content libraries, that would cost over $10 billion a year. That protects them. But intense competition everywhere means no true monopoly power. WBD absolutely benefits from economies of scale, producing 40 TV series and 15 films a year. They can do that at much lower cost per unit than smaller players like Lionsgate. Their massive global distribution network also cuts marketing costs by maybe 20% per subscriber compared to someone like Paramount. That scale is how a game like Hogwarts Legacy could make $1 billion on a $150 million budget. Smaller studios just can't match that kind of efficiency. It's like having a super efficient hit factory. The company also uses a smart counter-positioning strategy. Focusing on premium curated content directly counters Netflix's throw everything at the wall volume approach. For instance, HBO Max content apparently has 20% higher viewer retention per series. Think Succession versus maybe Stranger Things. That suggests deeper engagement, real audience loyalty. And on the global network side, having live sports and news clearly differentiates it from streaming-only services. Helps secure about $2 billion a year in those carriage fees. And then there's branding. Arguably one of their biggest strengths. HBO is the absolute crown jewel brand. It just screams quality. It has like a 90% viewer approval on Rotten Tomatoes. Warner Bros., IP Harry Potter. Batman commands incredible fan loyalty and lets them charge premium prices. That's why HBO Max can charge $15.99 a month versus Netflix's $13.99 standard plan. Now, Discovery's brands like HGTV, TLC, they resonate strongly with their specific audiences, sure, but they don't have that broad prestige of HBO. So WBD has strong pricing power in streaming, but maybe less so in the ad-supported network parts.
Which leads to the question, what unique resources do they actually have that competitors just can't easily copy? This is where the real strength of that moat, if it exists, becomes clearer. Well, first off, their cornered resources are pretty much unmatched. That intellectual property, Harry Potter, DC Comics, Looney Tunes, generates something like $5 billion a year. No other company has that exact mix. Second, their physical studios. Those Burbank and Leavesden facilities are massive assets. They handle 50% of WBD's production in-house, saving maybe $200 million a year in costs. Third, they attract top talent. Big directors like Christopher Nolan, showrunners like Mike White, they're drawn to that creative environment, which drives exclusivity, even if Netflix is always trying to lure people away. And finally, those long-term contracts for exclusive sports rights, NHL, MLB secure $1.5 billion in revenue. Though yes, potentially losing the NBA weakens that significantly. These aren't things you can just build overnight. They're the result of decades of strategic work, looking deeper at their process power. WBD's content development process, honed over many years, consistently produces hits like Barbie, which was barely 80% more cost-efficient than the industry average. HBO's process is particularly interesting. It's not just gut feelings. Think of it like a super sophisticated version of Netflix, but for premium stuff. They use data viewer analytics, genre trends, even script analysis to help decide which shows get the green light. This data-driven greenlighting supposedly cuts down on expensive floss by about 25%. Means they invest smarter in potential hits. Although global networks focus on lower-cost reality TV probably means less process innovation over there. Now, proprietary technology. Honestly, WBD doesn't really have a breakthrough tech advantage. HBO Max's streaming platform, it's solid, it works well, but it's not radically better than Netflix's. They are investing early in things like AI for CNN newsrooms and in gaming, but no major tech edge yet. The timing of their big moves has been a bit mixed, hasn't it? The streaming pivot itself was well-timed. Caught that 2020 boom. HBO Max launch got a boost from Wonder Woman 1984, added 10 million subs quickly, but the 2022 merger itself, poor timing. It right as the market turned down, which definitely contributed to that painful 60% drop in the stock price. Sometimes even giants stumble on the dance floor. Their execution speed has also been mixed. HBO Max scaled incredibly fast, 122.3 million subscribers in 5 years. That's faster than Paramount Plus Daguerre. And the cost-cutting, slicing $3 billion in 2023. That was swift, decisive. Yet there were strategic missteps too, like that confusing rebranding of Max to just Max and then back again to HBO Max. That certainly didn't help growth momentum. Plus, competitors like Disney seem to move faster on international expansion. Disney Plus launched in 120 markets versus HBO Max's 77. So is their moat sustainable? Probably yes, if they maintain content quality and keep chipping away at that debt. The HBO brand and that vast IP library are incredibly durable assets, but the ongoing decline of traditional cable absolutely threatens global networks. Investing more in gaming and expanding streaming internationally could strengthen their position, but the risks of erosion are real. New players like TikTok are grabbing younger eyeballs, 30% of Gen Z cutting cable.
Technology shifts like AI content could lower barriers, letting smaller players compete with WBD's big budgets. And finally, competitor scale. Amazon spending $20 billion on content versus WBD's $15 billion. That's a constant threat to market share. It really is a never-ending battle for attention and money.
All right, so how does this huge company plan to actually grow and stay resilient in this incredibly fast-moving industry? Well, the strategy after the split seems pretty clear. Two distinct paths for the two new companies. They're essentially placing bets on two different tables. For streaming and studios, the growth plan is all about aggressive expansion. First, market penetration. They want to push those ad-supported tiers on HBO Max, aiming for 50% of subs by 2027. That should boost average revenue per user by about 15%. More viewers, even paying a bit less, grows the total pie. Second, market development. They're pushing into new countries. UK, Germany, Italy launches planned by 2026, aiming for ambitious 30 million new subscribers there. And third, product development. Investing heavily, $5 billion into original content. Big projects like Superman, The Pit. They project about $2 billion in new revenue just from those. It's a full-on content offensive. Now, over on the global network side, the strategy is more about diversification and making the most of what they have. Market penetration focuses on growing Discovery Plus in Europe, targeting 40 million subscribers by 2028. Diversification includes launching that CNN streaming app, hoping to generate $300 million in revenue by 2027. And maybe most importantly, asset sales. They plan to sell off non-core channels like maybe TLC to aggressively cut $10 billion off their debt. This unit feels more like it's about hunkering down, optimizing, and shedding some weight. When you think about the total addressable market, the TAM, and WBD's potential, the opportunities are huge. Just expanding HBO Max into Asia Pacific could add 50 million subs by 2030, according to UBS. New product ideas like interactive DC games linked to the movies, that could bring in $1 billion a year. And after the split, streaming and studios might even look at M&A, maybe buying a gaming studio to boost their IP monetization even further. Breaking down the TAM, global streaming could be $600 billion by 2030. WBD wants 10% of that. Film box office, maybe $100 billion. Warner Bros. Aims for 15%. Cable and advertising, a $200 billion market. Global networks targets 5%. And gaming, a massive $200 billion market. WBD's current 1% share could grow to 3%. So, while HBO Max's 122.3 million subs position it well for maybe 20% of the premium streaming TAM, the shrinking cable market definitely puts a ceiling on global networks' potential.
Right. And if you connect all that back to the big picture, it's crystal clear they're betting heavily on content and expanding their reach. But the risks involved are pretty substantial. This isn't a guaranteed win by any means. It's a calculated gamble with very real stakes for investors. Let's consider their supply chain and customer diversity for a moment. Their supply chain is fairly diverse. but it has vulnerabilities. Content is mostly in-house, which is good. But their merchandise, which is a decent chunk of revenue, relies on Chinese manufacturers. That's maybe a $200 million risk if trade gets disrupted. Having partnerships with 50 global distributors helps reduce reliance on any single market. But the fact remains, 60% of streaming revenue and 50% of cable revenue still comes from the U.S. That makes them quite exposed to a U.S. economic downturn. Their customer base is broad streaming, cable, film, gaming. That diversity helps stabilize revenue overall. But again, that heavy reliance on U.S. consumers is a risk if the U.S. economy takes a hit. What about longevity? Do their core products have staying power? Probably yes, maybe a 70% chance of long-term relevance.
Streaming in studios definitely benefits from the big trend of more digital consumption. Global streaming hours are up 20% a year. Global networks faces that undeniable cable decline, losing 10% of subs yearly. But news and live sports, even with cord cutting, still hold value and have loyal audiences. A major market downturn could really hurt their ad revenue, maybe a $5 billion risk there. But HBO Max's subscription base provides a crucial cushion. And the strength of WBD's IP, plus their moves into gaming, really ensures demand beyond just traditional TV and movies. They own a lot of timeless assets. The key drivers pushing their growth are basically threefold. First, streaming subscriber growth, currently strong at 23% year over year, targeting 150 million by 2026. Second, that big content investment, $15 billion a year pouring into new stuff, projected to drive 20% revenue growth in originals. And third, aggressive debt reduction, targeting another $10 billion paid down by 2027. That frees up vital capital for expansion. However, the main risks of that growth, market saturation in streaming is real. Intense competition from giants like Netflix and Amazon with huge scale. And significant execution risks tied to the split itself. Disruptions, delays that could really derail things. This truly feels like a make-or-break moment for them.
Okay, let's get to the numbers. Because even a great story needs a solid financial foundation, right? The company's financials really tell a story of a ship trying to shed weight so it can sail faster. But it's definitely navigating some choppy waters right now. Their revenue in 2024 was $38.34 billion. But that was actually down 6% from 2023, mostly because of the declining cable business. Q1 2025 continued that trend. Revenue fell 10% to $8.98 billion, missing analyst forecasts. Looking at profit margins, it's a bit of a mixed picture. Their overall net margin was negative 11.5% in 2024. That's a $4.4 billion loss for the year. But if you break it down, streaming and studios showed an 8% EBITDA margin, generating $339 million profit in Q1 2025. That contrasts sharply with global networks' healthier 15% margin. Now, when looking at financials, especially for tech-age companies, there's this thing called the rule of 40%. Think of it as a quick health check. If a company's revenue growth rate plus its profit margin adds up to 40% or more, it's generally seen as being in great shape, growing fast and efficiently. WBD right now is only at 4%. That's a negative 6% revenue growth plus a 10% EBITDA margin. That's a pretty clear signal that overall they haven't found that sweet spot yet where growth and profit go hand in hand. Means they're either burning cash for slow growth or still cutting on profitable parts. Their return on invested capital, ROIC, was 3.2% in 2024. That's below the industry average of 8%. Suggests they're not getting the best bang for their buck on investments. In terms of cash and debt, their current ratio is 1.1, which suggests they have enough liquidity for now. Adequate. However, their debt-to-equity ratio is 1.2. While that's better than 1.5 in 2023, it's still high. And that $38 billion total debt remains a very heavy weight. On the plus side, free cash flow grew to $5.1 billion in 2024, up 10% from 2023. That's crucial for supporting that $2.2 billion debt payment we saw in Q1 2025. Looking at industry-specific numbers, 122.3 million direct-to-consumer subs, up an impressive 23% year over year. Great momentum there. But that average revenue per user for HBO Max fell to $7.50, down 9%, mainly due to those ad-supported tiers. Overall, their EBITDA was $7.58 billion in 2024, with streaming and studios aiming for $1.3 billion in 2025. It really does feel like a runner hitting their stride in streaming, but with this huge storm cloud of debt hanging overhead. How do these numbers stack up against their rivals? Disney reported $89 billion revenue, 6% growth, 12% net margin. Disney Plus has 164 million subs, beating HBO Max count, but WBD's streaming profitability is a bright spot. Netflix, the streaming leader, $33 billion revenue, 15% growth, really healthy, 20% net margin. And while Netflix's scale is bigger, its $14 billion debt is much lighter than WBD's. Paramount trails with $30 billion revenue, negative 2% growth, negative 5% margin. So overall, WBD's debt and negative margins are currently lagging peers. But that streaming momentum is the clear positive takeaway. Looking at trends, revenue declining 5–10% annually overall, cable losses offsetting streaming gains. Margins improving in streaming, 8% EBITDA now versus 2% in 2023, but overall losses continue. Debt is coming down $5 billion paid off since 2022, another $10 billion targeted by 2027, and free cash flow is up 10% yearly, funding both growth and paying down debt.
The implication seems clear. Streaming's rise could eventually make WBD profitable, maybe by 2027. But the drag from cable still risks short-term losses.
All right. So given all those financials, the really crucial question for you is, what is this company actually worth? And maybe more importantly, why does understanding value separate a smart investor from, well, someone just gambling? For you, the individual investor, valuation is like your compass in this volatile media landscape. If you overpay for WBD, you risk big losses if growth flows. But if you buy it at a discount, that could unlock some really nice returns. Okay, so how do we figure out what it's worth? We can use a few different methods. Intrinsic valuation, using a discounted cash flow or DCF model. This tries to project future cash flows. Based on their $5.1 billion free cash flow growing at, say, 10% for 10 years with an 8% discount rate, you might estimate a value around $18, $20 per share. DCF is great for capturing that long-term potential, but it's very sensitive to assumptions, especially about debt repayment. Another way is relative valuation, comparing metrics like enterprise value to EBITDA. WBD's EBITDA is around 8x. That's significantly lower than Disney at 12x or Netflix at 15x. That suggests, relatively speaking, WBD might be undervalued compared to its bigger peers.
And finally, there's sum of the parts valuation. This is really relevant because of the upcoming split. If you value streaming and studios at, say, 15 times its EBITDA, roughly $20 billion, and global networks at 5 times its EBITDA, about $15 billion, the total adds up to $35 billion. That's roughly $14 per share. Both DCF and sum of the parts seem well suited for WBD right now, as they help think about the two distinct units after the split. Okay, let's look at the competing arguments, the bull versus the bear case for this company. The bear thesis definitely has some strong points and voices behind it. Institutionally, you have analysts like Brian Weiser saying the split is just financial engineering. It doesn't fix the core problems, cable decline, intense streaming competition. Rating agencies Fitch and Moody's even downgraded WBD to junk status. They cited that huge $38 billion debt and major execution risks. UBS has a price target down at $9, showing real skepticism. On social media, you see retail investors echoing these worries. Posts on X complaining about Zaslav's greedy pay amid layoffs, fears about CNN layoffs after the split.
Some call WBD a sinking ship because of losing the NBA rights and that on-getting 10% drop in cable subs. The rationale here is that global networks' $30 billion debt and falling ad revenue, down 15% in 2024, could actually drag both units down. And streaming in studios, despite its quality, still faces Netflix's sheer dominance. 122.3 million subs is way behind Netflix's 277 million. Plus, execution risks like content licensing getting messy during the split could cost maybe $1 billion a year. Now, the bull thesis. This offers a much more optimistic view. Institutionally, KeyBank sees the stock hitting $20 plus by 2026. They think this split will unlock a hefty $5 billion in shareholder value. TipRanks has a moderate buy rating, $12.30 target. Signals optimism. That streaming segment's $1.3 billion EBITDA target and 23% subscriber growth really fuel this confidence. Retail sentiment reflects this too. You see users on X praising HBO Max's unbeatable content, Zaslav's bold vision. Posts often highlight Barbie's $1.4 billion success as proof of the studio's power. The logic supporting the bull case. Streaming Studios gets a 20% equity stake in global networks, providing out $3 billion in liquidity.
That can help fund HBO Max's push towards 150 million subs, and global networks' $30 billion debt. Bulls argue it's manageable with asset sales, maybe $5 billion from selling non-core channels like TLC. Plus, WBD's substantial $7.58 billion EBITDA and $5.1 billion free cash flow provide significant financial flexibility. So weighing these two, the most probable thesis, in my view, leans towards the bull case, though maybe not wildly bullish. The clear momentum in streaming that 23% subscriber growth, the $339 million Q1 EBITDA profit, seems strong enough to start outweighing the drag from declining cable. Crucially, the aggressive debt reduction, $2.2 billion paid down in Q1, and the tax-free nature of the split, plus getting 99% bondholder approval, that significantly lowers the execution risk. Yes, competition and the remaining debt are still big hurdles, but the fundamental improvements in the streaming business are hard to ignore. It looks like their gamble has a decent chance of paying off. And our discount analysis backs this up. At around $10.50 per share in June 2025, WBD seems to be trading below its intrinsic value, which we estimated between $14 and $20 per share using DCF and some of the parts.
That suggests a pretty substantial 25–50% margin of safety for you as an investor right now. The bull thesis supports a price target maybe around $15 by 2026. which strongly implies WBD is undervalued at its current level.
Okay, so where do things stand today? And what's coming up next for this company as it gears up for this huge split? The massive news, obviously, was the split announcement on June 9, 2025. Warner Bros. Discovery plans to split into two separate companies, streaming and studios and global networks by mid-2026. And they got bondholder approval for restructuring the debt to make it happen. Interestingly, even though they missed Q1 2025 revenue estimates by 10%, the stock actually jumped 14% in the month after the announcement. The market clearly liked the sound of the split. Another key development, the HBO Max rebrand. They're going back to the original HBO Max name this summer. Analysts think that move alone could boost subscriber retention by 10%. That's a big win for keeping viewers loyal. But not all news is positive. Potentially losing those NBA rights in 2025 is a significant blow. Could cost TNT Sports about $500 million in revenue. That hurts. Looking ahead, we'll all be watching their Q2 2025 earnings report in August. Need updates on streaming progress and debt reduction. And further out, those HBO Max launches in the UK and Germany in 2026 will be really crucial for keeping subscriber growth going. The current buzz among investors, especially on social media, it's pretty mixed, but maybe leans cautiously optimistic. On the plus side, you see posts celebrating HBO Max's killer lineup, predicting streaming dominance, calling the split genius for cutting debt. But there's plenty of negative sentiment too. People blasting Zaslav's pay as tone deaf during layoff, feels that CNN streaming plan might flop given the ongoing 10% cable sub decline. Then there's a neutral view. Acknowledges the stock price is cheap now, but wants to wait and see the split actually happen successfully. The dominant feeling seems to be cautious optimism. Excitement about HBO Max's potential, but still wary about the debt and the decline of traditional cable.
Which leads us right back to the core questions. Will this split really unlock insane growth? What will these two new companies actually look like? And critically for investors, which one comes out ahead? Well, insane growth might be too strong a word, but it definitely offers a credible path to meaningful value creation. For streaming and studios, you could realistically see 15-20% annual revenue growth through 2030, driven by hitting that 150 million subscriber target for HBO Max and spending $5 billion a year on content. Global networks. That's a tougher road. Probably looking at 5-10% revenue declines due to cable erosion. But asset sales and growing Discovery Plus could maybe stabilize it. The key takeaway for shareholders. The tax-free split plus that $10 billion debt reduction plan is projected to unlock somewhere between $5 and $7 billion in value, according to KeyBank. A realistic upside for the stock, maybe 25%. Aiming for $13-15 per share by 2027. Significant, yes, but not exactly earth-shattering insane growth. So what will these two companies look like specifically? First, streaming and studios, led by David Zaslav. Projected as a $20 billion valuation powerhouse.
It gets HBO Max, Warner Bros. Pictures, Warner Bros. Television, DC Studios, Warner Bros. Games, all the premium content assets. It'll start with roughly 122.3 million subscribers, take on about $8 billion of debt, and hold that valuable 20% equity stake in global networks. Its focus is purely growth, targeting a huge 200 million subscribers by 2030. Expected to drive $15 billion in revenue, targeting $1.3 billion EBITDA in 2025. It'll have a leaner structure, using this premium content to go head-to-head with Netflix and Disney Plus S. This is the growth engine, the shiny new part. Second, global networks, led by Gunnar Wiedenfels. Projected as a $15 billion cash flow machine. It houses CNN, TNT Sports, Discovery Channels, Discovery Plus Agent, Bleacher Report, the traditional media, and cash generators. Unfortunately, this unit gets saddled with the lion's share of the debt, roughly $30 billion. It faces the headwinds of the declining cable market, losing about 10% of subs a year. Despite that, it's expected to generate $10 billion in revenue and a strong $2 billion in free cash flow.
Investments in the CNN app and Discovery Plus aim for 40 million subscribers, but cord cutting and losing NBA rights will definitely limit its growth potential. This is the stable cash engine, but with significant weight dragging it down. Now, the million-dollar question. Which one wins? Streaming and studios is the clear winner in terms of future potential. Its 23% subscriber growth, that $339 million Q1 profit, the wealth of premium IP like Harry Potter and DC, that positions it for maybe a 15% compound annual growth rate through 2030, potentially even outpacing Netflix's expected 10%. Global networks, yes, it throws off good cash flow, $2 billion FCF. But the cable decline and that massive $30 billion debt really cap its upside to maybe a modest 5% CAGR. Our valuation projections suggest streaming and studios could be worth $35 billion by 2028. Global networks might just stagnate around $12-15 billion unless asset sales really accelerate debt pay down. So for you, the investor, the smart money for growth seems to be on streaming and studios. Global networks might eventually become more of a dividend play if they manage that cash flow well. And the why behind that is important.
Streaming and studios rides the wave of secular demand for streaming.
It has the powerful HBO brand, incredibly scalable IP, its $8 billion debt load is much more manageable, and being able to potentially sell that 20% stake in Global Networks could free up another $3 billion for expansion. Global Network news and sports assets are resilient, yes, but cord-cutting and volatile ad revenue, down 15% in 2024, will absolutely hinder growth. The very structure of the split pushing most debt onto Global Networks is designed to let streaming and studios take flight. It's almost a calculated sacrifice. Okay. Let's talk asymmetric information, risks, and uncertainties. This is where you, the individual investor, might find an edge. First, the investor edge. What might the market be missing? Well, HBO Max's 20% higher viewer retention signals potential untapped pricing power. If they can raise ARPU from $7.50 towards $9 by 2027, that could add another $2 billion in revenue. Maybe analysts are underestimating that. Second, the gaming upside. Hogwarts Legacy's massive success, $1 billion revenue, hints that Warner Bros. Games could become a $5 billion business by 2030. That often gets overlooked in current valuations.
Lastly, asset sales. Those non-core Global Networks channels like TLC, Animal Planet, they could potentially fetch $5-7 billion. That would cut debt much faster than expected, boosting free cash flow significantly. These are potential hidden upsides. Now, the key risks, the known unknowns, things we know could go wrong, execution delays during the split, renegotiating complex content licenses could cost $1 billion in 2026, delaying growth plans, competitive pressure, Netflix spending $20 billion on content, Amazon bundling Prime, that's constant pressure on HBO Max's market share, and regulatory hurdles. Could future M&A be blocked? That might be crucial for streaming and studios to gain even more scale later on. Finally, the key uncertainties, the unknown unknowns, the wild cards. AI disruption. Could it slash production costs by 30%? That might actually benefit low-cost rivals more than WD with its $15 billion content budget. Geopolitical shocks. U.S.-China trade wars could suddenly impact that $500 million in merchandise and co-production revenue. And leadership stability. What if Zaslav decides to leave after the split is done? That could really unsettle streaming and studios if there's no clear successor ready.
So what should you do? Well, consider buying WBBD around $10.50. It offers that 25-50% margin of safety. Focus primarily on the growth story of streaming and studios. Definitely monitor the Q2 2025 earnings for updates on subscribers and debt. And keep a close eye on any news about their gaming division to capitalize on that potentially undervalued segment.
Wow, what a journey. We've really taken apart this media giant, looked under the hood, and explored this incredibly bold plan to reinvent itself by splitting in two. For you, the individual investor, the opportunity here isn't just about understanding one company, it's really about seeing the future of entertainment taking shape right before your eyes. As this company gets ready to divide itself, here's something to think about. In this age of endless content where every click matters, will the future really belong to the focused, specialized powerhouse or to the diversified empire? And what does that tell you about the media landscape you'll be navigating next? Until our next session, stay curious, stay informed, and keep asking the big questions.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.